Good morning, everyone, and welcome to the Daily Trader with Kevin Hincks. I'm Kevin Hincks. I've got two paper money trades for you today on two high-profile names. We'll look at Nvidia after its recent sell-off, and we'll look at Supermicro, which basically in many ways goes in line with Nvidia. It's very correlated. So let's look at Nvidia first. Let's get to our first one. Now, what we're doing, if you choose to use a strategy like a diagonal spread, other than for bullish purposes, you have to be careful of long vega, right? Buying a further out date, selling a shorter date gives you long vega. So what you do to combat that is, or to minimize that, is to move those dates as close to up as possible. Okay, so we're looking at Nvidia buying the March 28th 107 call, but right at the money, and then selling the March 14th 112 call. Now you can go even tighter than that, but this is a fair amount of space between the two trades. It does give you $5.70 of long vega that you have to be cognizant of. That's risk if overall implied volatilities come down. The good news is, if implied volatilities come down, it's probably because the market's rallying and the 107s would be more and more in the money. So there's that trade-off, but beware of underperformance on the upside due to implied volatility if it were to start coming down off its lofty levels. Just something to think about. So buying the March 28th 107 call, selling the March 14th 112 call. The debit we have is about 520. It's trading about 510 now. The risk on the trade is the debit paid, and you're looking for, in the next just 3.5 trading days, a move up towards that 112 strike, and that's just slightly lower than the expected move, being a little more aggressive with our short strikes. In this case, $5 wide call diagonal in Nvidia. Remember, the risk on the trade, the debit paid. The target on this trade is the short strike, in this case the 112 strike, expiring on March 14th. That's this Friday. All right, our second trade is Supermicro. We're going to keep them very similar in terms of dates. Buying the March 28th, selling the March 14th. In this case, looked at the money call, the 37 call in the March 28th. Buying that, selling March 14th, lining up the expected move about $4, selling the 41 call. So the 37-41 call diagonal, March 28th to March 14th. I put that in about $3.40. It's trading about $3.35 right now, so it's trading right in these levels. These are trades. Again, this has $2 in long vega. So vega is the sensitivity to moves in implied volatility. So just be cognizant that you are long some vega there on this trade. Now, buying 2 weeks out, selling this week, the $5 implied vertical call spread in SMCI, and in Nvidia's case, it's also a $5 call vertical implied. 107, 112 in Nvidia, 37.41, only a $4 move in Supermicro, and the risk on both these trades is the debit paid. All right, that's our show for today, everybody. I'll see you tomorrow with another edition of the Daily Trader. I'm Kevin Hincks.